Welcome to the Babalian Money Show. You've probably heard that old joke. Economists have predicted 10 of the last 2 recessions. It seems like every day we're bombarded with terrifying headlines. Record high inflation, wars raging across the globe, and government debt levels that make your eyes water. Logically, the stock market should be in the gutter. And yet, the S&P 500 is hitting all-time highs. It feels completely disconnected from reality, doesn't it? So what's going on? Why hasn't the market crashed? Well, today we're going to uncover the 3 invisible pillars secretly propping up the entire market. The first and most powerful pillar is the AI gold rush. Now, when you hear that, you might think of the dot-com bubble in 2000, where companies with no profits were worth billions based on pure hype. This is different. This is real. Companies like Nvidia and Microsoft aren't just selling a dream. They are making staggering amounts of actual, tangible profit. Nvidia, for example, is selling the shovels in this gold rush, the powerful chips needed for AI, and their earnings are exploding. These tech giants have become so massive and profitable that they are literally carrying the entire market on their backs. The S&P 500's performance is heavily skewed by just a handful of these mega-cap tech stocks. Without them, the picture would look very different. That brings us to our second pillar, the surprisingly resilient consumer, but not all consumers. We're living in what economists call a K-shaped economy. On one side, many people are struggling with the rising cost of living. But on the other side, the upper middle and wealthy classes are doing better than ever. Think about it. These are the people who own homes that have skyrocketed in value and have significant stock portfolios that are also at all-time highs. They feel wealthy, and because they feel wealthy, they keep spending. They're booking flights, going on luxury vacations, and buying premium goods. This sustained spending keeps corporate earnings high for a huge slice of the economy, preventing the widespread slowdown many have been expecting. Our third invisible support is more psychological. It's an idea known as the Fed put. For decades, investors have been conditioned to believe that whenever the economy or the market gets into serious trouble, the Federal Reserve will ride to the rescue. How? By cutting interest rates. Lower rates make borrowing cheaper, stimulating the economy and making stocks look more attractive compared to bonds. This creates a safety net in the minds of investors. They are less likely to panic and sell because they have faith that the Fed has their back. This belief prevents the kind of widespread fear that can trigger a market crash, even when the underlying economic data looks shaky. So if everything is supported, should we relax? Not so fast. Here's the real risk. Market crashes rarely come from the problems we all see and talk about in the news every day. The market has already priced in the risks of inflation and geopolitical tensions. The real danger comes from a black swan, an unpredictable, unexpected event that no one saw coming. Think of the 2008 financial crisis or the 2020 pandemic. The silent killer to watch for is a liquidity crisis. That's when the cash that greases the wheels of the financial system suddenly dries up, causing a domino effect. These events happen fast and without warning. So what's the takeaway? The market is more resilient than the headlines suggest, thanks to high profits, strong high-end spending, and faith in the Fed. But it's not invincible. The biggest risks are the ones we aren't even talking about yet. That's why trying to perfectly time the market is a fool's game. The smartest strategy remains the simplest. Time in the market beats time in the market. Don't bet against the long-term innovation and strength of the economy. If you want more rational insights to help you navigate these crazy times, make sure you subscribe to the Babalian Money Show. Thanks for watching.